All right. I think yes, you can hear you. Okay. I think let's get started. Good morning, everyone. Welcome to the session. I think this week, right, we don't have Chi Keng joining, so but we have Hayden. So definitely there's good insight from Hayden as always. So we will kickstart the session right away. So if you have any questions, right, just unmute yourself and just voice your opinion or give your viewpoints. So don't have to wait until I call up your names. Yeah. So I think this should be an interactive session rather than me or just Hayden, two of us talking, right? You guys can also share. Okay, let's get started. I don't have any sharing, so we just go right to the slide now. Okay, first question from Anonymous. Despite Alibaba share price rising recently, my losses are still more than 10,000. Should I just cut loss and rotate to stocks on better discount? Baba, that piece of shit. Hayden, just for your information, I think this person that posts this person that posts this question, right? He actually posted like almost every week. I don't know who's the person. I actually suggested that he or she reach out to me, and then we can discuss in more details. But I still haven't received anyone like a private message to me. So we don't know who is this person. But it seems that there are people who are very interested to know like what is the current situations with Alibaba. And I know that Hayden, you are also like invested in Alibaba, right? So I think I will just point these questions to you. Please share your view.
Actually, I'm also not very certain of Alibaba's future, but I'm just looking at the current valuation. So I've posted a message on the chat group, right? So basically, it's being beaten down quite substantially, and the market is actually valuing Alibaba at its sum of parts now. It's not even predicting its future free cash flow. You know, it's so basically I've mentioned before, the latest interim report, they mentioned they have a EBITDA of 17 billion. That is if you discount away the new initiative expenses, so it's about 17 billion. So if you value it at 10 times, that's their core commerce 10 times, that's about 340 billion USD, which is the current market cap So the market is actually valuing Alibaba at its valuing it at its current core business EBITDA at around 10 times, and ignoring all the other businesses that they have, which is quite huge. They have about 50 billion of net cash, 17 billion of long-term equity investments. Also, their cloud is one of the largest. It's the largest in China, and it's growing. You know, and if you value the cloud at about 5 times revenue, that's about 60 billion. And also, so just basically valuing Alibaba at its liquidation value only, you know. So let's say if the company now, China government wants to break up Alibaba, you know, then which will never happen, but then that's the amount that you will get, the extra assets, free assets that you will get, So actually, when the stock price tank at this level, and there's a higher margin of safety, actually. So my view is just hold on to it, and see what happens, because the future is uncertain. But the thing is, China will not, I think, will not destroy their own domestic businesses, but they will try to regulate it very stringently. But I don't think they will want to destroy their own domestic interests, right? That's my view, my brief view.
Yeah, thanks a lot for the sharing. And just now I saw Chi Keng also join, but he told me he's still here, right? But Chi Keng, if you can unmute, you can just unmute and share your view. But I just want to throw a couple of questions. I know that if we look at the valuation, yes, it is very cheap and very attractive at this moment. But aside from the valuation, we also care about their competitions. I mean, how are they executing basically? So, for example, in their core e-commerce, right? Like there's always this competition with PDD, Pinduoduo, and also JD. So just want to know, like, are they executing well? Are they winning the war in China e-commerce, right? That's one thing. And then on the cloud business, I know Alibaba is still dominant and still number one in clouds, right? But the other, because China's cloud development is still early, in the early phase. So I believe others are also working hard to like enlarge their market shares, right? For example, like Huawei Cloud, Tencent Cloud. So are they defending their turf well on that area? And then the third part is their international business. I know that Lazada used to like lose out to Shopee, but now it seems that they also try to like win back their markets, right? So they are also doing some good stuff on the international e-commerce side. So I personally haven't really followed that closely on all these developments. So if anyone of you have anything to share on these angles, please just unmute and give your comment. If not, I'll just get back to Russia. No, sorry, get back to Hayden or Chi Keng. You are there. You can also share.
I think if you look at Alibaba's mode, basically, I'm not very familiar with its mode, but I would assume since it's the largest in terms of user base and in terms of GMV, and in terms of their logistics reach, because of their China now, right? They have a lot of data on different logistic party working together. So I think the EBITDA from their commerce will likely be stable. The group will not be too huge, but it will likely be stable. So you look at the little free cash flow. Every year, this year trading is about 30 billion. So if you assume to a certain extent, but their free cash flow will likely be stable. Billion free cash flow, which is more than Amazon. So what are they going to use this money for? I mean, they can either not paying out dividend to shareholders, right? They have to try to compound their growth, or either that try to extend or deepen the mode. So profitably, a profitable business, and it's churning out 30 billion free cash flow every year, assuming that it's stable. I mean, the margin of safety is quite high. That's what I think. But if you talk about in details, whether they are losing out to those loss-making companies like PTT or C, their market share, I think, medium to long term, they might even win them, because it's very hard to beat a free cash flow machine against. If you look at a company that is churning out free cash flow against a company that is basically trying to eat into market share by just undercutting the price and losing a lot of money every year, I think the company that is positive free cash flow will ultimately win in the end. That's my view, but it's still very uncertain. Yeah.
What are you uncertain on? Yeah. Like what's the things that you worry
because
about?
If you talk about China, everything is uncertain now, because it's a top-down approach, right? So you never know what the government is trying to do. What they say, they are trying to regulate, but they have been doing it for almost 1 year already. So I mean, anything that is a top-down approach, right? There's some problem, Yeah, because you get a lot of surprises, you get a lot of volatility. So if you are, there's a predicament there, There's an element of uncertainty, in terms of the governance, because it's top-down, right? Yeah. So
actually, since last time when the regulators fined Alibaba, right? That I don't remember, a few billions dollars. After the fine, I recall that Alibaba share price shoot out a bit, and then after that, it still continued to tank. But for maybe for other fines, right? I think Meituan's fines, all those come after that, right? I think the Alibaba's one they received quite some time ago. Actually, since that fine until now, right? Has there any new fines or any new regulations that actually kind of like have a huge negative impact to their business? Because I myself cannot recall any drastic changes after that. I thought the fines is already something that kind of like one episode is done already. And or anyone else can recall what was the latest changes that actually affect Alibaba?
I think it's a lot of factors. It's not only targeting the company. It's like for example, the nationalizing of for-profit tutoring industry in like after that, right? Erasing about 100 billion in market cap. All these are, yeah, it's not very good for investors lah. They will feel that wow, one day you can wipe out so much just by a snap of a like a press of a button, everything just gone. Also, the TT situation, yeah, the Beijing trying to ban it from app stores, and suspending registration of new users of WeChat. All of these things it's not really targeting Alibaba but it's trying to tell investors that a lot of this situation can be external factors that is affecting the company. It's not internal, So also they have been doing it every month limiting gaming for children under 18. So all these all these regulations and rules from the top down indirectly it will affect Alibaba because anything that's external and it's political or yeah it's like bad sentiments bad sentiments. But I don't think the fundamental will change. But stiff competition definitely is there So there are a lot of pressures from external and internal, and also competition, and also that's why it has been on a downtrend for almost 1 year, right?
Yeah, actually, the most recent one I recall is the changes of the the regulations on the algorithm. So basically, for these software companies that use algorithm, they will find a way to optimize the algorithm such that you will keep on sticking to the platforms, right? For example, like if you are on Douyin or TikTok, they will keep on pushing content to you so that you will stay on the platform and then just consume their content. And hence, let's say if it is an e-commerce platform, right, you will also stay on the platform for very long. For example, like Pinduoduo also have something like that you can play games on it, collect some pointers or something like that. Just want to make you addicted to the platform, right? I think this is something that is common among all these tech companies. And then now they have this new regulation that say you cannot do this and that. You cannot basically they try to regulate this area. So I think this is also quite bad for these tech companies, right? Do you have any view on this new regulation?
Actually, everything macro is quite negative, but I just basically look at the fundamentals, and how much free cash flow you can churn out, and then that's about, if you assume 30 billion free cash flow, that's I think more than 10% free cash flow yield, right, for this company, which is unheard of in the US market. And assuming that its GMV and its user base is so much higher than Amazon, and it's now going international, so there's some potential there. And if the company wants to unlock value, they can do it anytime. They can spin off their end, which they own 33%. They recently valued their perma at 10 billion, right? They can do anything they want, They can if they sell off their cash and their long-term equity, right? That's about 120 billion of value worth, to unlock if they want to, But the thing is, there are potential of value unlocking anytime if they want to, But if other than that, because of all these, right? I mean, despite the macro headwinds, right? I think there are still huge potential for Baba,
Sure, I get your message. Yeah, I do agree that on the valuation point of view, it's really attractive. So I myself didn't expect it can drop so much. Yeah. I mean, looking at the list there, anyone else, do you want to share anything, your view on China, on, let's say, any, like Alibaba specifically, or in more general, China? I saw like Chiang is also here. Martin, you want to share anything, your view with regards to Alibaba or not? I'll open for the floor. Anyone here invested in Alibaba? I just want to like. I know Hayden is invested. I have some small exposure. I don't know the rest.
Hey, I'm Corey here.
Hi, Corey.
Hey, and I'm also invested in Alibaba. Right? So currently I'm slightly 10K down on this position as well. I have this impression, maybe I could be wrong, like that. This common prosperity, right? Looking at all these Alibaba matrices, compound growth or whatever, right? Does it ever, is it going to make sense in a way that if Alibaba allowed to continue to grow, right? It's like it defeats the whole purpose of this common prosperity kind of thing, right? They are probably trying to like reduce the growth of Alibaba from onwards, right? So I'm thinking that, would they ever allow Alibaba to grow to be that big again? No. You know what I mean? So I'm looking at that as long as there's a rebound, right? Maybe reduce my loss 50%, I will get out. Right. That's my view. I could be wrong.
Yeah, Hayden, you want to comment?
Is that I say the current situation is quite uncertain, but the thing is, because Alibaba's business is intertwined with the government in terms of employment, in terms of GDP growth. So why would they want to hamper or slow down their GDP growth and cause a drastic drop in their employment numbers, right? I mean, they would want. It's very hard to say. It's very hard to say actually. I'm also not very sure. I'm just basing it on the valuation and what the company can do. So assuming every year they can get 30 billion of free cash flow. So even common first prosperity getting fined 2 or 3 billion every year. I mean, what are they going to do with their 30 billion USD in cash? They can do it. They can expand overseas and then get out from the CCP lens. They can continue to expand their Lazada, their Turkey business, their AliExpress. There are a lot of things they can do with all this cash they have churning out every year, assuming vis-a-vis companies that is bleeding and is trying to finance every year, trying to get financing, and it's getting harder and harder to finance in China now, right? So if you want to choose a company in China to invest now, right, at this current valuation, right, rather choose free cash flow sustainable business like Tencent and Alibaba, rather than companies that are loss-making, trying to gain market share just by undercutting the prices and then trying to get financing every year and hope for the best. These are more dangerous, I would assume. But of course, US and China are the top two economies in the world, right? So assuming now there's a huge divergence with China now dropping to almost Alibaba now is almost 2017 lows, right? So the thing is, with the kind of reach, the kind of mode, right? If you want to bet on China, I think it's one of the options, lah. One of the, I would assume, an option with higher margin of safety, lah. But of course, the future in terms of the macro headwinds is very, very uncertain. I agree.
Yeah, I think it's true that if we look at the valuations, right, because in fact, in the past, let's say 1 or 2 years, their fundamentals also still intact. It's just that the most recent quarter, okay, because of some undercutting or some competition reason, right, the result is not as great, but it's not that bad either. I mean, I would say that the fundamental is still intact. So what happened is that in order to justify current low price, right, actually the market already didn't price in that much of growth anyway. And in fact, when it comes to the discounting, I think the market also priced in a very sizable discount just because Alibaba is subject to all these regulation change or CCP actions, future actions, right? So I think if we just look ahead 2 or 3 years, right, I would say that as long as the government or regulator doesn't come up with new stuff that keep on surprise the investor or the markets, right, then this one I don't think it is a bad investment. But it also means that you need to be aware that this regulation change, no one has given any assurance that there won't be any new regulation that come up. If you are very stressful about why the government keep on coming up with new stuff that like try to attack the companies, right? Or make the company worse, right? Or make the share price cheaper, right? If you are very stressful on these kind of things, then I think it makes sense to just stay away, like, because I don't think it's fair or it's a good idea to bet that the crackdown has ended. So I think we shouldn't have that kind of assumption. But we can have certain assumption or expectation with regards to the fundamental of the companies. We can see the numbers, right? Are they growing, Lazada or not? How's their cloud business is doing? All these things, right? So that one we can track. We can monitor the business now. Yeah, I think we have enough discussion on this. Let's move on to the next question because we still have a list of questions. Some will I think will take some time also to discuss. So let's move on. US massive correction soon. Okay, this one I'll go first. So because, I think I also mentioned in the chat group, right? So now I actually layer my portfolio with a short-term position, which is short futures on NASDAQ. So that is a bit like a tactical actions from my end because, as you guys know, I have more than 100% exposure, right? So I have a bit of margin there. And then because of since the FOMC minutes that came out, I do have a feeling that the market haven't really fully realized that the shift of the monetary policy has changed. I do think that majority of the market participants don't really pay too much attention to this kind of things, because they will have some impact. For example, a couple of % drop, or even in the past 1 or 2 weeks, right? You can see that there's more red than green, right? But I think that if these things continue, right, like for example, US 10-year rate is like 1.7 or 1.8%. If it goes up to 2 or 2.2%, I still think that the valuation will need to be adjusted down. So that's why I kind of like de-risking a bit and then just like conserve a bit of cash and adopt a more like a wait and see and wait approach. But this position is not going to be a long term because it's never a good idea to bet against the best companies in US. So I'm thinking that let's say if there's more like some drawdown, for example, let's say maybe even 3 or 5% drawdown, right? I might just close the position and see how it goes. So this is something that got short term. That's why I can't give a very timely update. But because I opened this position, right? If one day I close the position, for sure I will inform in the chat group. So, but come back to this question, right? Is it going to be a massive correction? My opinion is no. It's not going to a massive, depending on how you define massive, right? Like, 5% is deep, 10% is only like correction, right? 20% is bear market, right? I personally don't think we will get into the correction. It could happen. I don't expect it to happen, but something between like 10 to 20% drawdown is always like it happens almost like every year, right? So you shouldn't be surprised either if it happened. Yeah. And the next thing to watch is always the quarterly earnings that will coming up soon, right? So if the earnings are all looks great, right? I also won't be surprised that market continue to rally even with a tightening monetary policy. So there's a lot of uncertainty here. So I'm not okay. That short position is a bit like market timing. I have to admit that. But how to say? I won't say that I know the market will crash. I just want to say I don't know, and I just want to conserve some cash just to make myself feel better. I'm not. If I already have 50% cash and only invest 50%, right? I won't do these kind of things, right? It's just because I started out with like invested more than the money that I have. So I think it's good that I de-risk a bit given this current environment. So that's a bit a short sharing from my side. Anyone want to share or give your view in terms of whether you think that there's any market correction on US? Please just unmute and share. Thanks a lot. No one? Just me solo talking? Okay. Let's continue with the next question. If nobody wants to unmute. All right. Next question. Do you have any advice for investors who are still students? By the way, who is student here? Or actually, if you post this question, you can also like unmute and tell a bit your story. What's the background? Like what are you in a university student, or what's your stage now, or are you like secondary school student? Because it really depends, right? Yeah. Just unmute a bit. Just want to hear like what's the background on these questions, right? Okay, nobody want to admit. Anyone else? Let's say if your cousin or your younger brother or sister, still student age, want to learn about investing. Any advice you want to give? Please share a bit. Just unmute and we take turn now. No one? Come back to Hayden again. You have any advice for students?
I think to open a brokerage account, you need to be 21 years old, right? But I think now there's this young investor account where you can open at 18 years old, but you need a parental signature. It's always better to start young to compound. I mean, if you talk about in terms of risk aversion, try a world ETF. You can just buy it every 6 months or every month, a small amount. That's my view.
Yeah. Don't start with the fancy one, right? Just something that is like more passive will always be a good starting point, right?
Yeah.
Okay. I think for myself, I think for student, how to say, I think it's good to start early, in a sense of you start exposed to the material and content. So, like with all these YouTube or blogs, right, you can always learn. And I do see that there are students who are very good with investing because they are exposed early in their early years, right? So you don't want to wait until you are like 40 years old, 45 years old. Then only you think like, okay, I better start to learn about investing now, right? So because during student age, I think that's the phase where you are like a sponge, right? You can absorb a lot of things. So, and you are also more open mind to different ideas, right? So I think that's definitely good place to start learning. It's just that maybe not a good idea to pay too much attention to the numbers. For example, like you only have like, let's say $2,000, $3,000, and you just want to max up the gains out of that 2,000 or 3,000, right? I think this is not that wise, because regardless of how much money you have, you still have long journey ahead, right? I think the bulk of money will come in when, let's say, you are 30 years old onwards, whereby you have a good career and then you have some saving. That's where the real money come in, and you can actually compound from there, right? But from in the early years, I think the knowledge part will be more important. So take the time to learn. Even if you want to experiment with stuff, I think that's always good. And then just learn as much as you can. Be open about it. Don't pay attention to the gain and losses. Even you want to learn trading also can, I think, because you don't know until you try it, right? So I think all of this, do some experiment is always good. Do some research. Those are all helpful. For the really solid kind of like compounding, build your portfolio, I think you want to have something very solid and something proven. And that's where all the like passive investment and long-term investing, invest into like good stocks, those will come in when you really have the money. I think that's all from my side. Anyone else want to share? If not, we just get to the next one. I think the next one also quite interesting.
I think what Boon shared I think yesterday about how to sell or when to sell. I think as a student also you need to read that because you have a lot of time in your hands, and then you invest early, right? You can I mean you read what Boon shared. I think Oak Tree Capital or something, that the article that was very
Oak Tree.
Yeah, that was very insightful, especially even for like long-term investors or for people who have invested long time, right? To understand when or how or why to sell is also very important. But as a student, I think you have a lot of time at your hands, so you can time as in you have a longer term horizon to let your money grow. So be patient also lah. Don't be too rash, because some people they don't understand the psychology of, you know, like paper losses or unrealized gains and all those things. So it's always good to get used to it early, and then maybe in the future when your capital is larger, right, then you will be less prone to make mistakes lah. It's always easier to start early than late lah. As I have also like friends that are in the midlife already, right, 30, 40 years old, and they feel even more afraid to start now because they cannot afford to have a large change in their financial position, and also they don't have time horizon on their side anymore. So then after that they procrastinate, and then in the end also they say, hey, I should have started 2 years ago. So it's as a student, right, you should start, but you know, keep in mind all the investment principles that you need to learn. Don't just say I want to make a certain amount of money, but then you don't learn along the way. That is not correct as well. Otherwise, because you won't you won't improve as a person also. So I think start early. That's the if I were to go back in time and tell my former university self also, I would say start early. 500, 1,000 also is okay. Ang pao money also okay. Instead of just waiting at the sidelines.
Yeah. Thanks for the sharing. I think, Kevin, this next question, I think it is also quite interesting, because I'm also interested to hear your question. It's actually open to all. Share the best cut loss experience you had and what you have learned from it. Because we know that you invested in Tesla, we don't know stuff that you have cut loss or sold some positions, right? You want to share something on this?
Let me think a bit first, because I can't remember the last time I really cut loss anything. Let me think a bit first.
Sure.
Share first.
Sure. Hayden, you want to share? Have you sold any position before?
I think if you look at cut loss, besides looking at the financial, you also have to see whether is this damage permanent or not. Yeah, because you can't base your investment decision on a quarter result. But you also need to have some foresight, as in to know whether, you know, this current impact or this current damage to the company is actually a permanent damage. Yeah, if so, cutting loss is necessary. Or if not cutting loss, you can talk about it as switching, switching to some other better companies. But if you talk about a young student that is starting to invest, and they stick to a world ETF, I mean, there's no reason to cut loss, right? Since it's a ETF, so basically they can just keep doing dollar cost averaging and ignoring the noise. I think cut losses is mainly for people who have like very concentrated bets, and then it's quite dangerous for them to hold on to a company that is actually terminally damaged, or the prospects will be impacted negatively in the long run. I mean, you have to know that, which is quite hard to do. Sometimes short-term losses for the company is not actually terminally, or it's not actually bad for them actually in the long term. So it's actually quite tricky to cut loss. So assuming if you are a young student investor that is trading, that is buying into a very expensive world ETF, I think there's no reason to cut loss, right?
Yeah, that's true. I think here, right, I just want to like explain a bit like the word cut loss, because I think these cut loss things, right, is more common when people talking about like trading, because you know, for those who do trading, they will say, okay, this is the resistance, this is the support, and let's say it breaks support, but right, you don't want to continue owning falling knives, right? So you just want to get up before others do. So there's this cut loss concept, meaning that hit certain loss, you are out already. Because for those who are trading, they mainly just want to ride on some trend, right? Either short-term trend or some longer-term trend. They just want to ride on it. So the moment the trend break, right, they want to get out already. And even if it is a loss, right, to them it's fine as long as you limit your losses. So that's where the cutting loss come from. But then if you view this, right, from angle that is someone doing investing, right, the cut loss part is very different compared to the trading. Trading, you can use chart to say this is the line or this is the level that I will cut loss, right? So if you are investing, I would just say that you will pay a lot more attention to the business, because if the business is doing well and it's just the price that is fluctuating, right? Maybe it's not a good idea to sell just because the share price is traded lower, right? So you might even want to invest more if the business is intact and the price becomes cheaper, right? Because stock can become cheaper for all sorts of reasons, not necessarily related to the fundamental of the business. So it could be due to some rate hike, right? For example, okay, rate hike, all stocks become rate. Does it mean that the business is worse? Actually, most likely no, right? So you need to distinguish, like, okay, why you are thinking about cutting loss, right? So if you think that the business is good, I think this is really not so relevant from long-term investor perspective. But with that said, I just want to share a bit like my own experience. So when I think about cut loss, right, when I read these questions, right, I'm thinking about the position that I own in around 2014, maybe let's say 2015 to 2017. That's the period where I own some Singapore stocks. Specifically, I own Sembcorp Industries and also Keppel Corp. So these two companies, right, okay, they are like conglomerate, so not just oil related exposure, but definitely the oil exposure is like one huge or the main risk exposure that these both companies are exposed to. So initially I thought that, okay, they are like almost like value peak. The earnings looks good before the oil price slump in, I think, 2016, around that region, that time. So I own it, and then the price kept dropping, and the commodity price also dropped, right? So I think that's where I try to reassess my investment philosophy. Like, do I really want to own these companies? Do I really like have a view on the commodity price moving forward and so on, right? So I just realized that actually it's not a good idea for me to own like commodities, because it's really hard to predict where the price is over the long term. Because let's say if it is a business that is keep on compounding, right, we will have some visibility on where the business is going. But let's say even if the business is okay, or the management is okay, but it is subject to something that you have no control of. Commodity is a good example. So it's just not something that I want to be exposed to over the long term, right? So what I did is I just cut loss and move my exposure into ETF. So at least that's something that I did. But I didn't make that decisions because of some technical chart analysis like that. I have, you guys know, right, I'm totally noob in terms of all this TA thing. It's just that I look at the companies that I have invested in. I realized that, no, this is not something that I want to own anymore. Even if it is a loss, right, then I'll just sell it and move on. So try to control my how to say, the emotional part. I know like cutting loss or realize losses, right, it's always something that's painful, right? For me, I'll just move on. I think that's more important than just hanging on to a position that I don't like, but I just keep on hanging to it because it is unrealized loss, So this one, I try to avoid that kind of like sunk cost fallacy. Yeah, so a bit of sharing from my side. Want to come back to Kelvin or anyone else, like have you like cut loss before or sell your position before? What is your story back then? Please just unmute and share your story. Thanks.
I think the most prominent one I can remember is I sold the Michael Kors. If you know this brand, last time Michael Kors was doing quite well. They are in the affordable luxury segment. So my wife also liked that brand. So that time I bought it without much research Okay, so I think that also is the reason why when the price didn't move much and then it went into the loss territory, I just sold it off because I didn't really understand the business. And I also feel that as my wife start to show, you know, like there's no brand loyalty in that segment. Maybe I can say that, because it's like it's not like they don't have the brand power like LV or Gucci, you know, where they have brand loyalty. So it's like in the middle of, it's not so expensive, it's not so cheap, and then it's also the quality also not so good. You know, those like in the middle, you know, not the leader of anything. So and in the end, I think I took like a 20% loss. So I just sold it off lah. And I think this lesson, what lesson I have is that when you buy something without doing research, and when the price did not reach what you feel you are hoping for, you tend to just look at the price, and then you tend to, you know, not understand the business. You tend to not know where the business is heading, so you have no horizon, you know, no aim, no goal. So it's very difficult to have a conviction at that time lah. So and the funny thing is that only after I bought it, then I start to, like, you know, really try to understand the business. So I took this as a lesson, not to, you know, not to just like have a perspective of just from an individual, because my wife likes this brand and I just buy it. So that's also a lesson. So try to do a bit of homework before. Another one, yeah. Another one,
just a question before we move to the other one. The 20%, how much is it, like, in absolute terms?
I can't remember, but I think it's less than 5 figures in US dollars lah.
So few thousand
lah. Thousands lah, yeah.
Wow, okay. Like, was it very painful that time when you made that decision?
Yes, at that time was, yeah. That time I think a few thousand was like 5 to 10% of my portfolio. That was very young time lah, a very long time ago. Yeah.
Okay,
roughly
okay.
Like that, yeah.
Okay, yeah. Move on to the next one you want to share.
Yeah, and then in another one is not really cut loss. It's just that it's a break even. So I used to invest in ARM, right? The one that is going to be, or hopefully can or may be acquired by NVIDIA. I used to own ARM. At that time, that one I know a bit more of the company because I was working in the mobile division. I worked in Nokia and Continental. So in Nokia, we are working with the Cortex architecture, the ARM Cortex. And then after that, in Continental, we were also considering of using the ARM architecture in the sensor chips and some other devices lah. So I spoke with one of the engineers. So they are like, they say that there's potential in this because of the low power consumption. So I looked into it a bit and I thought, hey, this is quite a good company. They are very high margin. So because they license their product, right? They don't have foundries or forges and so on. So I bought also not a big position, less than 5 digits or so in US dollar terms. And then what happened was Brexit happened. So Brexit happened, and then because that time I did not know that political uncertainty sometimes will not really affect the fundamentals, but because of that uncertainty, right, the price dropped to where I bought it. So I quickly sold it off. And then Brexit, after Brexit happened, right, after Brexit vote, the first referendum vote, and then I sold it off and I didn't bother about it. And then right after that, SoftBank acquired it for like, I think 20 or 30% above what I bought. So that's also a lesson for me, is that sometimes like regional or very, like political uncertainty, if the business is still intact, if you understand the business fundamentals, right, it's sometimes not so prudent to just sell it off so quickly lah. Okay, so maybe SoftBank saw the potential, right? So they bought it when the price was down. I think that was the two most prominent ones lah I can share.
But that one is not really you selling, right? That one is because they offer to buy over the entire companies, right?
No, I sell before they announce the acquire. So I didn't know that they're going to acquire.
So you didn't enjoy that premium that they offer lah?
No, nothing, because I think maybe a small loss even, small only lah, more or less break even lah. So and then after a few days I sold, then they announced that acquisition.
I see. Actually, I have another similar experience also. There's a Singapore company called Dewtech. Very similar, as in it is a very how to say, considered value picks. So their PE very low, business is okay-ish. They are mainly doing all this ATM. So I think they also have some business or some manufacturing in Europe as well, and China, Europe, and Singapore basically. So it is Singapore listed company. So I own it just because I think that it is cheap and then should be something that's good investment, and held it for years. I think maybe at least 3, 4, 5 years, something like that. And then I think during COVID that time, I'm thinking, okay, now COVID, right? Everyone is moving into all this app payment. Before this, we don't have that much of app payment, right? So I'm thinking, okay, probably not a good idea to own companies that is doing all this like ATM, building ATM machines, right? So I think, okay, it's time for me to cut loss. Just move on, right? After I sell, then the company's got, I think it's like just 6 months after that, it got privatized at a premium also. So if I just held on longer, then I get to enjoy that buyout, right? So also similar situation. So that's another story of mine. All right, I think we move on. If not, I think the question keep coming in. Let's move on to the next question. Is Upstart a pump and dump? Pump until 400, then dump so hard until 120. And actually, we have a member that invested in Upstart before, but I reached out to him, I think last week. He was quite busy this period. So we don't hear much of his, we don't see him often. But I think this company we briefly discussed before, and also last week when we had discussion on Palantir, at that time we also briefly talked about this company, right? So I have nothing more to add, but I just want to say, I think this is quite common, especially those companies that people pay attention to. So it's like there's this uptrend and traders just keep piling in, right? So these traders are not long-term investors. The moment they break the trend, right, they will all exit and see who exit faster than the rest. So that's why you see this kind of drop is something that is could happen, especially for companies that is yet to make money. So really hard. There's not much of margin safety, I would say. Then with all this rate hike stuff coming, so I think all the short-term traders, they are exiting. That's why you see the price drop back to 120. But whether the business is good or bad, I really can't say much because I haven't do much study. If anyone has done any research on this, feel free to share and then we can discuss in more details. Anyone else want to share or want to give your view with these questions?
Hi, Budi. Yang here. Can I share something on this?
Hi, Yang.
Morning. Yeah. I have a feeling that the person who asked this question feels like it's more of trading and not investing. And I think that's very important, distinguish between both, especially if you go into the pre-earnings kind of growth companies. If you go in with so during early years also, I always go in thinking I'm investing. Actually, I'm trading. So I'll see, okay, this. Okay, for example, Baba now price very low. Is it time to get in? This thought itself started with the mentality that, price is low, I should get in, and not, okay, company is good, I should start looking into it and start paying attention and learning. And if the price is right, then I get it. So I feel this Upstart, like, earlier years, there has this GME, AMC, even Tesla during their 2010 to 2015, it was this kind of bump and dump, up 300%, down another 80%, go on 100%. So so I think the first distinguish, whoever asked this question, or if you want to start dabble into stock market, know that the difference between trading and investing, and be clear on what you're trying to do, then you only can achieve a better, sustainable, long-term result. When I say long-term, it means 5, 10, 30 years kind of result. It's not like 1 year, 2 years. If you want to make fast money 1, 2 years, then go to Solana and Luna and Bitcoin and Ether. Yep.
Thanks for the sharing. Yeah, I think that's definitely true. People usually start with the trading mindset. Buy low, sell high, lock again, then can go eat crab, right? I think that kind of mindset, right? I think it's quite common. Even now, there are still many people have this kind of mindset. Without them, market is not liquid, so also tough. So you definitely have need this group of people to help maintaining them, providing liquidity to the market. All right, I think good sharing. Let's move on. I think this one we discussed already. Okay, this question. But Chi Keng, let me check. Are you still here? Because Chi Keng is not in here already. Chi Keng and Master Leong are both perma bull of Alibaba. Can trust them, may? Alibaba drop until so jialat. I think we discussed a lot on Alibaba just now. I think consider this is answered. Or anyone else you want to give any comment? We can unmute. Okay, no. Let's move on. Kelvin.
Thanks. I think we have to distinguish that nobody is going to be 100% right every time. So I think the issue of trust is that you have to make your own decision. Even any analyst or anyone who is being paid as their job, right, to do any analysis, it's all they are giving their opinions or their expertise based on what information that they have also. So you can actually interpret information in different ways. So I think this anonymous to say that you can trust or not is actually up to you because nobody has a crystal ball. Nobody has a real like 100% information. Even if your information is correct, right, it may not be reflected in the price. Okay, so even like in this group, right, everyone is listening to Boon, but Boon is also human. He doesn't have the 100% true, or he can see the future. So we are just trying to get access to more information, and then we try to help everyone. Maybe those who do not have time to access or evaluate so much information. So we have more people like Chi Keng who can dive deep into the Alibaba to provide that information to you. But if you want to trust or not, then it's all up to you, personal opinion. I don't think you can say that you try you can influence other people and say can we trust this, can we trust that. So you have to make your own decisions. Don't try to how do I say that? Don't try to put down others or try to influence others to trust someone, or even to say like if more people trust this person should be trustworthy. It's very personal, I think, this kind of opinion. So hopefully that as the community grows, right, you will see actually a lot of differing opinions. So it's not saying that if the stock price reflects or the performance reflects that this person A is right, that means you should trust person A, but we should evaluate him on that effort that he puts in, and also the quality of the analysis that this person provides. Then you make your own decision on whether you want to trust or not. I don't know if that makes sense, but I hope that we can grow together in a more positive manner, instead of just blindly trusting anyone, even paid analysts. So just be careful, because even paid analysts, professional people, they also have their own agenda and so on. So just go along and try to learn.
Yeah, thanks, Kelvin, for the sharing. Yeah, I do definitely agree on what you just said, and I also want to add that we shouldn't judge whether they are right or wrong based on the share price movement, right? Because if the share price go up, then they are God. Then if share price drop, then they are stupid. I think this one shouldn't be the case, right? Because whether share price move up or down within, let's say, 6 months or even 12 months, right? It really depends on the market consensus at that point of time, right? So, the money just flow here and there. It's just majority think this way for this short period of time. what if like Alibaba price just double from here over the next 12 months, right? Then so are all these conclusions all need to be reversed again, right? Not the case, right? So I do agree that yes, we need to judge based on their analysis. Just listen to their point of view, and then you come up on the conclusion yourself. Then you have to live by your own actions and your own decisions, right? So don't follow too much. I think this question is also very related to the next ones that are coming. So let me read it out. Followed Chi Keng to buy Alibaba over the past year, regretting it so much now. So I'm not sure if this is the person that that lost $10,000 on Alibaba. Sounds like the same person. But I think my opinion or my view is still the same. You shouldn't follow the actions. You should listen to his view, then make a judgment on whether you think that he's right. You can borrow his opinions or his analysis, right? But you still have to accept that you decided to buy the stocks yourself, right? Because if you think that, okay, now you lose money and then that's because Chi Keng's fault, right? Or someone else's fault, right? Then you will never learn, right? I think this is even much more detrimental to your entire financial journey rather than one decisions that you follow the wrong persons. You should always have your own, your own judgment. And then you also need to reassess your judgment over time so that you can refine your skill and your viewpoints, right? So that you will become better over time. Don't blame others. Someone who keep on blaming others, right, will never learn themselves. So this is even a bigger liability compared to, let's say, a 10,000 or even 50,000 loss, So mindset is very important. Kevin, you want to share anything? Because this is also related.
Oh, thanks, Bunti. Sorry, just want to add on a little bit.
I think
for first question, yeah, Alibaba drops until so jialat. I think that this notion itself is definitely not is definitely not a notion that you want to stick with as an investor, right? I mean, you as an investor, you're technically also a business partner, a silent business partner, and the share price shouldn't even be on your radar, right? Unless it's a very cheap price, then it should be under your radar. But otherwise, more often than not, your time should be more on how did Alibaba's logistic business doing, right? How did they grow their cloud business, right? Are they still growing okay? Are they still doing okay like that? That's the most that would be the focal point for you as a silent business partner per se. Right? And I think to the point where Chi Keng, Master Leong, and all these people, right? If you take a look at Warren Buffett's track record in the early years, right? If you were to follow him and then invest into what they call it, textile manufacturing industries, right? Textile manufacturing company, like what he did with Berkshire, right? Because Warren Buffett at the time was famous, and then you thought, oh, he is definitely the guy. I need to follow him to invest in this textile manufacturing company. And 2 years or 3 years afterwards, Warren Buffett regretted. It was a huge mistake, right? He learned from it, right? So in a way, they can see that even with people like Warren Buffett, the saint of investment, so-called, right? He also made mistakes, right? So in a way that we shouldn't be idolizing people, right? But what we can do is that we can learn to see how Warren Buffett sees it. We can learn to see how Chi Keng sees it. Right? We can learn how they see Master Leong sees it, and then in the end it comes back to you, right? Whether you think that point of view makes sense or not. So yeah, that's it.
Thanks, Juwai. All right. I think the last one, I think also related. Let me just read it out, these questions. Any thoughts for Master Leong's advice? Could we trust him for both Alibaba and Tesla? So I think just now, Juwai gave a good response with regards to all these following advice from all these gurus, right? But I mean, for those who are not familiar with Master Leong, let me just say this. I have watched a couple of his YouTube shorts. So he basically is very bullish on Alibaba, and then he's saying that Tesla is very overvalued, and all these US tech stocks will crash. So this is his viewpoints. So I think the comments that we just made when we answering the previous two questions, I think still applicable for this. So the short answer is don't like trust the person. Just listen to his view, because even though I in the past I also say, okay, Master Leong's content is very entertaining, but whether factually he's right or not, I'm not 100% agree with all the things he said. But there are also stuff that he said that I think I can agree with. For example, he said US valuation is high, and then China's valuation is low. I think these are something that you can actually cross-check, right? I do agree that in terms of valuation, that's true. And if you look at Tesla, again, it's come back to your own expectation moving forward, right? Because if you assume that Tesla growth in the past 1 year, we all seen the delivery numbers, right? Which is great, right? If you think that this growth is only like temporary, next year they might only grow by, let's say, 20%. Then the year after, maybe they will slow down to 10%, right? Then I also agree that Tesla is massively overvalued. So overvalued or not is relative to the intrinsic value, and the intrinsic value is always linked back to the growth prospect or the growth assumption that we assume, right? We individually assume, right? We all come up with different assumptions, right? So that's why we say we need to really each of us individually need to assess it, and then compare with the stock price, compare it with your DCF, and then you come up with your conclusion on whether all the things that like Master Leong or anyone say is true or not. You can cross-check it yourself. So yeah, that's something, that's my sharing. Anyone else want to share? Yeah, go ahead.
Yeah, I think every investor should have a certain level of critical thinking. Don't expect to be spoon-fed. And because if you expect to have all the answers just from one person or from one viewpoint, right, then you'll start to blame that person if that viewpoint turns out to be wrong. So you have to, I think, I'm not sure about Singapore, but like in Malaysia or as an Asian, right, we tend to lack a bit of this kind of creative and critical thinking. So I think we should take this as a lesson, especially in investment, that all these viewpoints, right, is just a tool for you to come up with your own conclusion, with your own decision. So you take the information that they provide, and then you give it a thought, like, does it make sense, or does what he say actually will affect what will happen? Okay, so that is something that you need to learn instead of just taking everything at the surface. That if he's saying that if interest rate goes up and then tech stocks will go down, instead of just understanding, just taking that at face value, you try to understand, is it really true that if interest rates goes up, tech stocks must come down? Is it how much will it affect? What about historically, does this ever happen before? Understand the mechanics behind what the person has said. So I think maybe as Asians, right, we tend to not have this kind of way of thinking. We tend to accept everything, like in the university, we tend to accept everything the lecturer says. So from my experience, right, I was my first semester in Germany studying in the engineering, in mathematics especially, right, is so eye-opening, because as an Asian, as a Malaysian, right, we learn differentiation, we learn calculus, we learn negative numbers and everything already in our secondary syllabus. But in Germany, right, only those who go to the more elite schools, they actually learn like the calculus early. But those who go to the more vocational type of school, right, their grasp of mathematics and like differentiation, all this is a bit lower, or they didn't even get exposed to it yet. But then when they start the first semester of mathematics, right, we start again with calculus and all those. So when the professor like explain negative numbers, right, for us we say, oh, okay, yes, like that, negative times negative or positive, but for what really opened my eyes was that one student even asked, right, why is negative times negative becomes a positive? So it's very, I can't even answer that myself. right? So that is something that we have to learn to, instead of just taking what the teacher or guru in the internet or talking head says, try to find out fundamentally, is it really true? And then you can get more conviction or you get more understanding of the topic at hand.
I think good questions there. Why -1 times -1 is positive? You still remember the answer, Kevin?
I can't remember actually. There is a very good explanation. There is an explanation. I can't really remember, but it's on the internet nowadays. You go YouTube, you'll find sure go on. I can't remember.
Yeah, because very interesting. I haven't heard of these questions. I myself are very into maths, but this is a good question. I think it has to do with something like when you multiply with a negative, you kind of like negate it, right? Maybe stuff like that. But it's like getting more philosophical, I think.
No, you can actually like symbolize it in the number line, if I'm not mistaken. And then there's also another one. You know the factorials. You remember factorials, right? The exclamation mark. Yeah.
Yep.
Like, why is 0 factorial 1?
Wow, good question. I think this is defined, right, or no?
Yeah, 0 factorial 1, because factorials is actually the number of combinations you have, right? So if there is 0 items, the combination, there is also one combination, you have 0 items.
Yeah.
Something like that.
Wow.
You can go and check it out.
Good stuff. Okay. Thanks. All right, let's move on. I think this is also interesting questions. My portfolio consists of just tech and growth stocks now. Should I also buy into an index such as the S&P 500 to kind of hedge my portfolio? I think this is a very good, valid questions there. Anyone else? What's your idea with regards to this question? Actually, when I read this, I also kind of like curious. What does it mean by tech and growth stocks? Because it's very different, right? For example, if you say my tech is Apple, 100% Apple versus like 100% Upstart, right? Sounds like both are tech, but they are very different also, right? So it really depends. But I think regardless of that, I think this is a good thing to discuss. Should you? I think when the person asking this question, my guess is that okay, should you just dominate or concentrate your portfolio into just one sector, or should you like diversify into S&P 500? Because under S&P 500, you will have all the sectors, right? So for example, now people talking about like sector rotation back to financial, energy also doing well. So I think it's valid to ask like, should we have exposure to other sector as well, given you started out from a tech heavy portfolio? I'll go first. I think it's good to have some diversifications. Because if you are too concentrated, right, what it means is that your portfolio could be also quite volatile. Because for example, like now interest rate increase, if you don't have the financial and energy to help cushion it a bit, right, then it is really volatile if you own only tech stocks. Depending on your appetite, if you are strongly believing in the companies that you invest, right, and you don't care about like volatility, you can just sleep well, right? Then I think you don't need that kind of concentration. You don't need that kind of diversification. But I think for a normal person, if you think of these questions, right, then I think it makes sense to deploy a bit. For those who have like strong conviction on the pick or the sector that they already choose, right, they don't even ask this question, So if you're asking, then I think it's fair to have some allocations. Just to make sure that you are exposed to all sector, and then just to help up with the volatility also. I think that's my view. Anyone else want to share? Yeah, no one want to share? Hi, Yang, please go ahead.
Yeah, I think it's a good way if you have some spare cash and you think you are fully allocated to some of your picks. For example, if let's say you have 50K then you have allocated maybe 30K to your picks, then you have 20K more and new one coming in. You're not sure if you want to add on to your current pick or you want to invest in the stock market but without doing as much homework. Then yeah, just go S&P 500 and QQQ just to stay invested, but without the time invested to do the research. And also if you feel your pick is quite over allocated and you want to limit the size, yeah, this is a good diversification method.
Thank you. Yeah, I think I think there are quite a number of people, so when you ask them, they will just say, okay, you shouldn't even do your own stock pick. You just invest in S&P 500, right? There's a good reason why there are many people who are advocating like S&P 500. It's because of one is diversifications across sectors. Two is they already, S&P itself is not like, they have all the good companies, all the large cap is there, right? So you also have a decent allocations as well. If you look at the breakdown of sector, also there's already tech inside here. So with all this sector rotation, it also help cushion out a bit. So I think it's always good. So I might even say that if you are not too sure on your own pick, right, you should start with S&P 500 and only move to individual stocks when you have a strong conviction. That is even a better idea. Okay, let's move on. Any thoughts on China upcoming GDP this coming Monday? I'll go first. I don't even know there's a GDP release coming up on Monday, so I don't have any response on these questions. Anyone else monitoring China or monitoring all this economic? You want to share something? Chiang, are you there? I'm not sure whether you monitor this kind of schedule, like upcoming economic data. Okay, I think no one want to give any view or no view on this. Let's move on. Thoughts on oil and gas stocks? Anyone? So quiet. Go ahead.
Oil and gas, if you're looking to invest in oil and gas, you really need to be very familiar with the first thing, the commodity price, the crude oil price and the movement in that, and also the full value chain of oil and gas, like which part of oil and gas are you into? Integrated one like ExxonMobil, Dutch Shell, and your I don't know, your Chevron, or you into your more local play like your Malaysian FPSO player, your certain vessel supplier and things like that. So there's a big whole value chain that you need to be familiar with, and crude oil price plays a big role in the market of this thing. So you must really be familiar and also know your intention of investing into specific oil and gas companies, because they may play out differently. For example, if you go into FPSO versus if you go into ExxonMobil, for example, and because they actually face different challenges, and so their revenue source are widely different, from exploration, from drilling, some even more from retail. So you have to be very familiar before you go into it, and it's really challenging unless you're an insider in oil and gas, as in if maybe you work in oil and gas, or you have friends working closely with oil and gas and things like that. Yeah, so it's a tough place to go in. They are easier play but yeah, if you want to have a try, then please be prepared
Yeah, I think that's definitely true, because we tend to like describe them as a sector, right? But actually, you go into it, I think they are. Now the oil price is already like much higher than, let's say, March last year, right? Or the year before. It's much higher now. But if you look at the oil companies, right? Some, let's say, they are like engineering related, right? Don't know, they're doing drilling or whatever, right? You look at the share price is still like haven't recovered compared to 2 years back, right? So I do think that we really need to pay attention to which segment it is. So not all oil stocks are the same. That's one thing. And then the second thing is that with regards to like short-term outlook, I personally feel that maybe over the short term, and short term being like 1, 2, or even 3 years, right? I think this sector might do well just because of the underinvestment into oil companies in the past, let's say 2 years or 3 years, right? So there will be limited supply, and then as long as the economy continue to recover, right, the demand will increase. So just because of these supply demand things, I think oil price should be supported and then might even become higher, and all the inflation things also help, right? So to me, it could turn out like a good trade if you are into it for like some not so long-term kind of investment. But for me personally, I totally like try to stay away from this area, because I think if you like go in with a 1 or 2 or 3 years outlook, right, you just want to earn a quick bucks, right? Yes, you can earn like a decent return if this thesis turn out to be right? But you just need to keep monitoring the situation, because on one end is that this supply demand things that I just talked about, right? On the other end is that there are so much investment into renewable as well. So all the solar thing, nuclear, and so on, this will also come in, right? Because everyone want to move into these ESG friendly sectors, right? So I think if you look ahead, like longer period, let's say 5 years or even 10 years ahead, right? I think for sure renewable will be a much larger market share or larger piece compared to now. And would that exert a downward pressure to oil price or not? My guess is yes, but I really don't know. So it becomes like a speculative kind of things if you bet on it over the long term, right? So that is not something that I personally interested. That's why I will stay away from them. Like you pick your fights, right? And this is not a fight that I want to pick now. As I mentioned earlier, that I say I invested in like Semcom Industries and also like Keppel, right? I can see that the moment all these things turn, right, it can turn very drastically and oil price can just collapse, right? So I don't know whether this will happen or not. So it's just, to me, not a margin of safety if I am exposed to oil price. That's why I'm staying away from it now. So that's just my personal view. Anyone else want to share on this? Because I don't recall we discussed anything on oil and gas before. Yeah.
I would like to add on, don't underestimate investment trends, because nowadays everyone is talking about ESG. And also, another thing that I don't really like oil and gas stocks is because it's very hard to see what is the competitive advantage between the different oil and gas companies. And also it's very, sometimes it's politically driven, it's also not immune to conflicts. So to me, I would not invest, but you need to do your research a lot, especially most of the oil and gas is also, you are not visible to you, right? The most is you just pump your petrol in the petrol station, but sometimes you don't care which brand also, right? So to me, I wouldn't put my effort into trying to capitalize on this sector.
Yeah,
hello?
I think.
Yeah.
Go ahead,
Yeah, back
Hayden.
to the previous question about the GDP of China, although it's not very important, but if you can look at the trend from January to June 2021, right, they have achieved about 12.7% expansion, but you don't know whether the numbers is real or not. But assuming this current quarter, right, I think it will be slow growth, because due to the their zero tolerance for the Omicron policy and also the property headwind. So likely this for 2021 will be about 8%, and 2022 will be much lower, will be about 5%. So that's why the government there is trying to ease now. It's trying to ease by reducing their interest rates. Other than that, that's what I know currently.
I have a slightly different opinion. If I think China may actually increase their interest rates, because if the US increase their interest rates, there is a danger of the interest rate difference being too high. I think the China also do not want to have that big difference between the the yuan interest rates and the US interest rates. But that's just my opinion. So that's what I've heard from some banks.
Yeah, it's very hard to say. It's very hard to ascertain. But currently they have already cut their one year loan prime rate, only a small amount, from 3.8% down from 3.85%. So it's very hard to say. So see how it goes.
Yep. All right. Let's move on. Buy the dip on TR or Palantir. I think if you haven't watched the last week discussion, please watch the video. I think we have a deep dive on Palantir. So that's one thing on Palantir. Second question is buy the dip. I think this one come back to what Yang just shared, right? When you say buy the dip, you are having this trading mindset, right? And I think for this group, we try to keep the trading discussion out of the discussion. Not to say that trading is useless. It's because, when you have a trading discussion and then you have an investment discussion, sometimes these two doesn't gel very nicely, because it will be a headache when it is a buying opportunity from investment perspective, but from a trading perspective, it looks like shit, right? So how should you do, right? So I would say, please be clear on what you're doing. Even if you thought that you are investing, but you are still thinking like, I should buy the dip, I should lock in profits, do this kind of things, which is very normal in trading, right? You need to be aware that is a trading mindset. So that's my comment from me. So I got nothing more to add. Anyone else want to add on this? All right, let's move on. Is 15% annual return on investment over the long term a realistic and good result? Haha. Anyone else want to share? What's your outlook? Because this one is quite broad. Just say that long term realistic, doesn't say this is which market, which style of investing. Maybe let me share first. Because I've seen some data on this, right? When this question is asked, right, we are doing investing. Let's just focus on the stock investment. How should we come up with return expectations, right? Because you don't want to make this assumption based on some personal view, right? So you always need to come back to the data. And the only data that is, I would say, objective enough, right, is actually the historical data. So, people who pull out the historical data of S&P 500 or let's say like some global index, and they do analysis, right? They will tell you that, okay, globally, the average return global stocks, let's say, is 8%. And then S&P 500 maybe is like around 10%. So that is something that is backward looking. You are essentially trying to describe what has been the stock market performing in the past, let's say, almost like 100 years, right? Actually, there's this study done by the Credit Suisse. I think later maybe I'll just share in the group that is quite comprehensive. They have like 110 years data on different geography, right? So I think that is something that is objective enough to have a sense on around how much is the return. But that is like history, right? No one can assure you that the stock market, just because they have done 10% in the past, then in the future they will do 10%, right? This is anyone guess, right? It could be even like 15, 20%, right? Or even like 0%, right? It could be. So nobody can give this kind of assurance. So I think starting from that 10%, I would say that you should take that as the starting point, like a best estimate. Anything on top of that 10%, right? It has to become it has to come from some outperformance against the market average, right? And I just want to say one thing is that it is not easy to outperform the markets. So that one, anyone that can tell you like, why do you invest in this? You should just invest in certain investment. I can do 20%, 30% a year, right? I think anyone who give that kind of statement just show that he himself doesn't have much experience in the stock market, right? Because anyone who is in stock market for, let's say, even 10 years, right? You will experience COVID crash. You will experience, let's say, 2016, that time, like China, all this currency devaluation, also there's some minor corrections, right? So you go through enough this kind of correction, then you will appreciate that it is not easy to outperform the market. So I would say lower down your expectation a bit, starting from 10%. And then, of course, from that 10%, if you can do something about it to improve it, that's even better, right? But don't think that you should assume, like, let's say like a 15% or 20% moving forward. I think that is a bit on the aggressive side, but definitely is achievable. Not to say it is impossible. It's still achievable. Just that I think it's prudent to assume something that is closer to average. Yeah. I think this one, you can survey people around you, right? Let's say experience of driving, right? You ask 10 person driving, are you how's your driving skill? Is it like above average or below average, right? Probably you'll get like 70 or 80%. They will claim that they are better than average. But I mean, this is people who collect these informations, right? This is the statistics, right? But it cannot be, right? You cannot have like more than 70% of the people that is above average, right? I mean, statistically speaking, there's only like 50% of people who is above median, yeah. But people always have like overconfidence. Okay, wow, today I solo talk too much. Anyone else want to give your point on this? Yeah.
I can say a bit, which is that when you're buying stocks, right, you're buying a business. So doesn't really necessarily mean that the stock price go up or go down. Then you base on that as your benchmark, the return on investment. If let's say you buy Amazon, and Amazon like let's say revenue has increased by 20% this year, but the stock price remain the same. And then let's say all other factors being the same now, right? Do you still consider Amazon a good buy even though the stock price never changed? Everything else increased by 15%, all its metrics. Then the answer would be that yes, because it has gone bigger. Your business literally has gone bigger. It's just like you have a business and your business grown by 15%, but its stock price never changed, and you never give out dividends or do any stock buyback, but it's fine. But you are happy with it, right? Because you have a company that has grown 15%. So when you look at just looking at stock price itself, it really doesn't make much sense, because if you are looking at eventually when your business is growing a lot and your stock price still doesn't change, people will eventually know that it is undervalued or is doing something that has been doing something consistently well and doesn't look like anyone can overtake it and things. Then people will definitely buy in at some point in time. It's just a matter of macro conditions, right? Maybe the macro conditions now aren't good, but who knows, maybe the macro conditions 3-4 years later are very good, and then suddenly your company just gets all the gains that it has made in the past reflected in its stock. That can also happen. It is not something like instant reflection of how well your business is doing is directly shown on your stock price. Yeah.
Thanks for the sharing. Definitely true. Let's move on because we have still a list of questions to go through. Yeah. Okay. This one, can I sue Chi Keng and Master Leong for my losses on Alibaba? I think no comment on this. We have discussed about this. TSMC still can buy. Okay. Let me give some update on this. So like TSMC, they just released the result last week, right? So the results looks good. But I think it looks good also not something that is like a huge surprise, right? Because we all know that this chip shortage is still we're still having this chip shortage, at least for this year. So maybe next year onwards they will improve. What I try to share here is that if you notice that they changed a bit when it comes to the guidance. So I think 2021 last year, they spent like 30 billion in capex, and then this year they say they're going to spend like more than 40 billions. So I think this is another step up compared to last year when they say they plan to spend like 100 billions in capex over the 3 years, right? So another step up. So what I'm trying to say is that when these companies, right, when they try to expand, building new fabs, it's very, very capital intensive. So we're talking about tens of billions. If you just look at their earnings, right? Their net income is not like these companies, they earn like 100 billions. They just spend 30 billions capex. That's relatively speaking, it's not that huge, right? But it's actually no. The amount of spending is actually large, and it's still very large compared to how much they earn. And the only reason why they still continue to do this kind of spending is because they do see that there's a demand on the chip. And then that's why they are expanding, right? Because you know that you are building up some fabs. You're going to churn up a lot of chips, let's say 3 years, 4 years down the road, right? And they will be returned. And I think someone also pointed out in the group, right? They say, okay, why the gross margin is so high, can be like 50%. That's true. Their gross margin is really quite high. But you have to bear in mind that this gross margin is only possible because not many fabs or not many semiconductor companies is able to come up with like 3 nanometer or 5 nanometer chips. There's only 1 or 2 companies, right? Either Samsung or TSMC, right? So when they dominate or they monopoly this so-called advanced nodes, right? So they have pricing power. With that pricing power, they can have a good gross margin, and also, of course, their net margin also looks good. But the downside is that they have to keep on spending in terms of capex. And when you look at the cash flow itself, right, for let's say this year, last year, or this year, or even next year, right, you won't see that much of cash flow because all this cash flow, a lot of all this cash flow will go into like capex. But they are investing for the future, right? So they are invest to the extent that for the competitors, it's very hard to catch up. So 2 things they cannot catch up, right? Number 1, they cannot catch up in terms of their R&D because they are just not as good as TSMC. And then number 2, in terms of the capacity, they cannot match TSMC capacity if they just keep on building fabs, like 40 billions down just to building up fabs. So you can see that few years later, right, TSMC, they are already dominating now, and few years later, this domination will only increase. Okay, so I think just from the business model, from their innovations, from the tech, from how the management is managing the business, right? I would say don't focus on the price now. It could be like 130 or 140 now, right? As long as they maintain this dominance, right? These companies can go to, let's say, $200, $250, $300. It's not a problem, you know? So that's on the business side. That's why I'm not even watching on the share price that much. To me, I'm mainly looking at the business, right? And the business is really a good business. That's one thing. The thing on the risk side is that because TSMC, all the advanced process nodes, or even all the new one that's coming out, like 2 nanometers, right? They have no plan to build 2 nanometers fab, at least for now, in other places other than Taiwan. It will be in Taiwan. And that's their strong core, right? The others fabs in, let's say, US or even Japan, these are like maybe like the US one, I think is 5 nanometers, right? Considered advanced today, but when the fabs start running, it's not the most advanced already. So they have a very concentrated exposure in Taiwan. And when you have that kind of exposure, if China's like do anything crazy, right, then please expect that the TSMC share price will just collapse. I mean, if China just say they want to take over Taiwan, use their military strength to do something crazy, right, then I think this investment will be gone. That's why I would say business okay, but there will be geopolitical risk. So just do your position sizing accordingly. Even for myself, right, I'm not all into this company just because of there will be things that will be outside of my control. So I need the position sizing to make sure that even if TSMC fail, my portfolio will still be standing. So that's my point. So sorry again, long answer from me, but I think it's worth to take this opportunity to voice out my opinion with regards to TSMC. Okay, let's move on. Or anyone else want to say anything on TSMC on that questions? Okay, no. Let's move on to the next one. Why do people still invest in Singapore market, all boomer and boring stocks? Anyone else want to share on this? We haven't talked Singapore stocks as much as well. Anyone still investing in Singapore? I myself, I still have some exposure. Very small compared to my US portfolio for sure, but still I have some exposure in my SRS account. How come no one's responding? I think my personal view on this question is that I think people who invest in Singapore market, they want different things. You know, like there are all sorts of different metrics, right? So if you want a company that's growing fast, for sure you will go for US stocks, right? For example, you look at like how much let's say companies like Tesla, we are not talking about like 10% growth, right? We're talking about like even higher than 50% growth, right? So if you pay attention to growth, you will definitely go to US. But there are also investors who pay more attention to, let's say, dividends. They just want stable dividends, right? So I think Singapore market is always a good place to earn if your main focus is on dividends. So be it like Singapore banks or REITs, right? These are all compelling reason to own. So just different investment philosophy. So you end up with different kind of investment. That's my view. Anyone else want to share a bit? Like, do you still invest, or do you think it makes sense or doesn't make sense to invest in Singapore market? Any viewpoints?
80% of my portfolio is in Singapore market. I think 50% is probably REITs. I'm a dividend investor actually, so I only have like 15% in the US market.
But how much do you like when you read, let's say, investment news, right? Do you still focus a lot on US market, or you mainly just look at like Singapore?
Both. But I started mainly with dividend investing like 5 years ago, and it's more like cash flow, right? And you build up your base, right? So it's like once you have enough base in rates, right, and the cash flow, then I start looking for growth, right? And this is where last year, right, I start looking for US market. So it's like one stage at a time, right?
I see.
It's like investment growth.
Yeah. Do you mind to share, because I haven't like really messaged you in the past, right? Do you mind to share like how old are you? Let's say you cannot give the exact, just give the band, the range.
I'm in the 50s, early 50s.
Okay. So you have been collecting like dividend stocks for many years, right? How do you still remember when you started investing?
20 years, I think 20 over years ago, I was playing Warren kind of. It's a lot of speculation. Then maybe about 10 years ago, I started dividend investing. Right. So, but that time, 10 years ago, when you do dividend investing, you make a lot of capital gain as well, in addition to the dividends. So, so it has been a good ride for the past 9 years for dividend investor, right? And because of the capital gain as well. And yeah.
Yeah, what's the rough breakdown, right? For example, like among like let's say Singapore banks versus like Singapore REITs?
On probably my banks now is I've been studying them in stages for the past 1-2 years. The risk is typically bigger. It's like almost 40-50% of the portfolio. The banks is maybe about 10%, 15% the most.
Yeah, I see. Actually, for those who are like not so familiar with Singapore REITs market, right? Actually, if you look at the past 10 years of data, the return is actually quite decent. I recall it is like more than 10%. Singapore REITs market CAGR over the past, let's say, 10 years. Should be more than 10. It could be like 12 or 14% that kind of return. So it can compound, right, with that kind of a percentage total return. But of course, you don't see that much of the share price increase, because let's say if the dividend is 4 to 5%, you get capital appreciation of another, let's say 5 or 6%, right? It adds up to 12%. But just looking at the price, you only see half of the return. The other half is actually came in as a cash And then, of course, you can redeploy the cash to continue to buy again, right? I think that's something that harder for those who just look at the share price and say, hey, the share price doesn't climb as much. Yeah. So in terms of dividend, do you do you really do in-depth analysis to the REITs and then just or you just buy all of them? But what's your strategy when it comes to REITs dividends?
It's for REITs, right? You still have to be selective because it's very risky if you look just for yields. It's very, very risky. You can, like EHT, right? You can go bust, right? So you still have to do a bit of diversification. You still need to select the stocks that you still have a basket of stocks. Let's say I have like eight REITs on average.
I see. Just can I pick your brain on one more thing, sir? On office REITs, because we know that since COVID, right, there are quite a number of companies that actually downsizing their office space. For example, I can share that my companies also have this policy, like floating desks. Let's say they only have capacity for 50%, then the rest will actually work from home. And this is not like just for COVID measure. This become like almost like already a permanent thing. So and I like just when I think just this week, actually standing at my office and I just look opposite building, right, and I can see that actually quite a number of floors that is vacant. You can see the light, and those that didn't turn on their light during office hour, I believe nobody is renting the place, right? So just want to get your view. Do you own any office REITs at the moment, and what's your outlook when it comes to office REITs?
I do have office REITs, but the main one are like in Europe, right? The iREITs and the Elite. Right, so they are, and the recent one in iREIT, like the tenant did not continue, right, for the whole building, and they're able to get replacement quickly, right? But there's not enough information whether how much the rental is, but it looks like in Europe side is still pretty good, right? The building get occupied quickly. Even for my company, right? I have colleagues in France, and they also have a lot of people work from home, right? And it's like some of them like 5 days, they only come back to office 1 day, but they still maintain the whole building and make it into like the cafeteria bigger, the meeting room bigger, more meeting rooms. So the amount of space is still the same. But in Singapore, I'm not very sure. I do not have much of this in REIT Singapore. Maybe exposure like in MCT, right? But I did not go very in depth because some of the office are very like high end. I think maybe my feeling, right? It's not very in depth. Is that they're able to get replacement? Maybe there's the weakness in the renter they'll be receiving, but I think they still can manage by. That's all I know.
Okay. All right. Thanks a lot for the sharing. I think in our group, we mainly spend a lot of time talking about like US stocks. I think mainly also because of some self-selections, because I share my portfolio and my portfolio is still considered like tech heavy, right? So we don't discuss Singapore market that often. But for, let's say, if anyone interested with like, let's say talking about Singapore investment, right? Of course, we can do a dedicated session, let's say with Corey, we can discuss a lot more into like all these REITs investment and so on. So it really depends on like some requests. Anyone you can request, then we can see how we can schedule one. Okay, let's move on. I try to end this session, let's say in 15 minutes. We'll just like discuss a couple more questions on the list here. This one we have discussed. Any good recommendations on local investor that can provide sound value investment advice? So is this like looking for which influencer or which blog writers to recommend, something like that, if I understand the questions correctly? Please correct me. I mean, friends here. I think, there are a whole bunch of lists. It also depends on what you want to learn. So I think YouTube is a place to go because I'm myself also on YouTube. I promote my channel a bit. Aside from that, there are people who write blog also. Like for example, like Hayden's also has his own blog. If you are interested with what he shared, right, you can also read his blog. And then like Keith, investment modes. I think this is definitely good resource. I think those are also good to listen or read his blog. I think there's a bunch of resources, but you want me to list down one by one now? I can't do that. Or I'll just open to the floor. Anyone else have good resources or any local investor that you think worth following and just want to share? Yeah, I already gave a couples, right? And then Adam Khoo, I think his YouTube also not bad actually. Like I watched the most recent one, like he talked about like whether there will be a market crash, right? Then he gave his viewpoints, right? For example, like whether the PE looks high now, but the PEG is not that high. I think there's some points that is quite valid, and then his video is always like quite engaging. So I think also worth to watch a couple of his videos. Like the fifth person also not bad. Local investor. Who else? Maybe we can share in the group so some of these resources or maybe we do a compile document just to share. Anyone else? If not, I move on. Yeah. Is ARK a good investment? Anyone invest in ARK? I look at the list here. I don't recall anyone invest in ARK. So this one, I think I also discussed before. I even made a video with regards to ARK investment. So if I recall correctly, right? Okay, my viewpoint is that first, this is an active fund and it is rather concentrated. So it is not like just like mutual funds and then they still more or less follow the benchmark and then just do some minor tweaking in terms of the weighting. It's not the case. So in terms of number of stocks they invest, right, it's only like around 50 or so. So rather concentrated, and they are concentrated into companies that is have certain characteristic. And most of them, right, actually loss-making companies. And they say that they invest in these companies because they are like innovative, and then they have they have a products that is very good. So that's why they invest in these disruptors, right? So I look at these companies, right? For example, companies like Zoom, Coinbase, Tesla. I do feel that these are the companies that is really innovative. But you also need to have certain comfort in the sense that if the companies is not making money, right, there's always a question on when they will make money, right? Because right now, as we mentioned in the earlier, right, all this monetary tightening will come, interest rate will rise. For the companies that is not making money, they are actually quite jialat also, because if they are not making money, means that they will need fundings from the capital market. So usually two ways they can either borrow debt or they can raise capital by issuing new shares. Borrowing debt is also something that is limited, because if you borrow debt and then you cannot turn profitable within short period of time, right? Meaning that you still need to continue to borrow debt. And once you go over leverage, right, like the risk of bankruptcy will be becoming like quite big now. So that is also definitely a concern. So that's on the debt borrowing. If they don't borrow debt and they just issue shares, right, then you will be very worried on the dilution already. If the share price drop and they need to issue shares, then become permanent loss already, because the new investor will have a chance to buy in at the low valuations, right? So I think this risk will always be there for companies that can't make money now and then they don't know when they are going to make money, right? So when the interest rate increase, right, investor will lose patience. So valuation will drop. So I think that's the risk that you need to be comfortable with. So this is true, let's say 2 years back, 3 years back, it's still true now. So you really need to wait, like maybe watch a couple of videos from Katie Wood and then see whether you buy into her visions or her strategy or not. If you are comfortable, then I would say she whatever she explained, right? I think you can see it's reflected in her portfolio. So you need to have that kind of trust in order to invest now. But if you're not, right, then just stay away. I think it's totally fine. Yeah. So that's my view on ARK. Anyone else want to share your view on Katie Wood or ARK investment? All right, no, let's move on. Do you have any advice for investors who are still university student? I'm not sure if you are new, like just joined this discussion. This question actually we just discussed like before earlier in the session. There's a couple of good advice for those students. So I think don't have to repeat that. I'll post the recording later. Okay, next one. Should I buy S&P 500 or QQQ? I think if you are asking this question, I think you should just go for S&P 500, just because S&P 500, right, is a more balanced one. QQQ relative to S&P 500, right, is that QQQ, they're actually excluding all the financials. And then they have 100 names instead of 500 names. So just because of this, right, they are more concentrated. Of course, they are only for those listed on NASDAQ, right? So for those listed on NASDAQ, usually they are more like tech focused, right? So if you are into tech, it's okay to own QQQ. But if you are asking this question, means you are not sure, right? And if you are not sure, I think you should fall back to the one that is more balanced and more inclusive, which is S&P 500. So I think that's my answer. Anyone else want to share your view with regards to these two? All right, no, I think let's move on to the last one. What do you think about having a stop loss in your portfolio? Survey first. Anyone has stop loss in your portfolio? You can share and justify. No one? Everyone just tune in just to listen only. Like no one doing sharing. Just a couple of like Kelvin, Hayden. Kelvin, do you have stop loss or not? Tesla dropped 10%. You better sell all your Tesla.
Nope. I don't even know what is a stop loss.
Nice one. Yeah, I think come back to the one that we just mentioned earlier, right? Stop loss as a concept is very common when you are doing trading, because trading itself is already like a very short-term kind of things, right? If you say, I'm going to trade this position because I think of certain reason, right? Then 3 months later, you still own the position because it dropped, right? Then you back holding for 3 months, 6 months. Then you become long-term investor. This one doesn't make sense, right? Because if you go in with a short-term mindset, then you better get out with also the short-term mindset, right? Because you need to know this is a trade, right? So to me, stop loss is okay if you doing trading. But if you are investing, then you shouldn't have a stop loss, right? Because it just doesn't make sense. I mean, this concept just don't apply for those who is doing investing. With that said, I also have some short-term position. For example, like I have this shorting futures, right? I personally, even for that positions, I don't have a stop loss, because in order for me to lose a huge money on that future position, then my main portfolio will have a big gain. So also not a problem for me. But if I'm doing a naked short, right, then of course you need to have a stop loss, because even if you don't do stop loss on that and you are doing a naked short, right, the brokerage will have a stop loss for you. So when the things go skyrocket, then they will help you liquidate also. So same thing, right? Yeah. I think that's all. I think first thing is that you need to know whether you are trading or you are investing. If you are investing, then I find it hard to justify a reason to have a stop loss. So that is just my own view. Anyone else want to share? This is the last question, or anything else like you want to share? Not just this question, just open to the floor for a couple more sharing. We will end in like, let's say 5 or 10 minutes.
I think stop loss makes sense if you are trading only, like what Punti said. because you are actually just looking at price movements and momentum. But if you are investing in the company, it doesn't really make sense to have a stop loss, because if you, let's say if I have Tesla at let's say stop loss of 20%, right? And then if suddenly it just drops to 20%, but I still feel that, hey, I actually still want to own this company, but it just doesn't make sense. And then suddenly everything sold off. And then what I'm going to do? Am I going to like wait it go down and then I buy more? Or is it, I don't know. It's like, it doesn't make sense if you are investing in a company. It makes sense if you are trading, definitely. And give you another example. When I used to own Fosun International as well, I did not have a stop loss also, but that one I think also I got a bit of a not loss, also a big drop one time when their CEO went missing. Then I didn't have a stop loss, but what I have is that I have alerts in my phone or in my app that if there is any like big news, right, on some of my holdings which I want to monitor, they will alert me. So what I got I got an alert in the, I think, early morning, 4 a.m. or something like that. It says that the CEO suddenly went missing. So I thought, hey, this might be something very it might affect the company lah, because this is a key man risk in the company, which I had in my investment thesis at the early also. Because if something were to happen to this CEO, then I would definitely sell no matter what the price. So when I got this alert, then I sell whatever the price. I just sell. It's not a stop loss, but just sell because it is against what I have already previously put in my research already. And then it turns out he really went missing for a few days. I don't know why also. But after that, I didn't went in before. I didn't went in again because to me it just like not fitting my investment anymore. So that was just another story.
Yeah, I think if you go in with a mindset of like, okay, this is a fundamental good prospect that you go in, right? Maybe a stop loss that is based on fundamental will make more sense lah. So I give one example. For example, we say, okay, Tesla, in order to justify current valuation, you might think of it will grow by 50%, right? Then maybe we should have something to say, what will need to happen for you to consider selling? One good example is that, for example, if tomorrow Elon Musk announced that he will resign as a CEO, and then second announcement, he said he's going to sell all his shares, and then third thing, they're going to appoint some don't know who come into the business to become CEO. And then fourth thing, they said they announced something crazy that they will stop investing in R&D because it doesn't make sense for Tesla to continue investing in R&D. When this kind of things line out, right, then maybe it's a reason for you to sell, right? I mean, this is just a very extreme kind of situation, but I think stop loss meaning that you need to have some trigger for you to exit the position, and what will that trigger looks like, right? You enter, you thinking that Tesla is innovative, but is there any criteria or any metrics that will point towards evidence that they are no longer innovative, right? Maybe it makes sense to track these kind of things, right? What do you think, Kelvin?
Yeah, I think you can set up alerts or like news alerts that can track this kind of matrix now. Because if normal brokerage is just like based on your price, right, market price. So to me, I don't do that. Doesn't make sense. Unless you are trading now. So trading means you have to have like capital management, right? Then that makes sense now. But I agree that you can also have alerts based on the metrics of a company. For example, let's say Tesla, you can say that you can put alerts on like Elon Musk. So anything that happens or in the news that comes out, Elon Musk, then you can consider lah. You read the headlines and you see suddenly Elon Musk says something. And if it's against what you have already set out before, then you can then consider to sell lah. And I know that when the news comes out, it will be too late or something like that. But that's the nature of investing lah. You can never be 100% certain. Just take your losses or your gains and then leave for another day lah.
Okay. Thanks a lot for the sharing. Okay, one last question. Yeah, we haven't discussed this one. Maybe we really need a dedicated session for this debate about value versus growth. So let me read the questions. Over the long term, 5 to 10 years, generally growth or value stocks perform better. You have any viewpoint, Kevin, since you are talking just now?
I don't really follow this one, but I think growth was really on the topic of everyone's mind the past few years, right? I think so. If you're talking just for the last 5 to 10 years, I think growth outperformed the value stocks. But that is on the very, I mean, if you are really breaking down value and growth stocks in two separate segments, it's also very blur the lines between growth and value stocks. So, but I think in my feeling, I mean, not based on any statistics, my feeling is that growth did perform better the past 5 to 10 years.
Yeah, 5 to 10 years definitely growth better. But later I'll put up some chart and then we take a look. But I think this is a good debate because there are some people who say past 10 years because interest rate low, hence favor growth. Let's say now inflation at 7%. If continue like this and interest rate going to increase, right? Does it mean that value stocks will outperform, right? I think this is also a valid question. I think we will just do a dedicated session for this. Maybe I will need to invite someone who can have more viewpoints on this. Maybe I invite Keith. But let's see. Okay, I think that's all for today's session. I'll share the recording later. And yeah, thanks a lot for those who are contributing and help answering questions here with the sharing. Thanks a lot, and enjoy your lunch. Thank you so much. I'll end the call now. Bye bye.